This episode is brought to you by Plaid. Plaid helps lenders approve more creditworthy borrowers without taking on more risk, combining real-time cash flow data with behavioral insights. It's a fast, familiar experience people trust and that actually converts. Learn more at plaid.com/FTT. Hello, and welcome back to the Fintech Takes podcast. We have yet another edition of Fintech Recap with Jason Mikula. It may seem like we've had Jason on a lot, which is true. He came on for the first recap of the year. We also did a bonus recap edition based on his reporting on the sanction evasion app Contigo. So despite the fact that he's been on a lot recently, we had a lot to talk about in this episode. We started the discussion actually talking about a television show that both of us are kind of obsessed with recently, Industry on HBO. So we do a little industry watch to start the show. If you're watching and don't want to be spoiled, you might want to skip past that part. And then we get into the actual news, which is not that much less crazy than what's happening in industry. We talk about crypto and stablecoins and Coinbase and its fight with Jamie Dimon and the big banks. We talk about the window for bank charters being wide open, so open, in fact, that Jason has come up with a new term to describe it, which includes a whole bunch of companies, most recently a firm applying to get a bank charter and what we think that means for the space overall. We also talk about the Brex Capital One deal and try to do some sort of non-VC Twitter analysis of what the deal actually means for banking, for fintech, for the corporate card and expense management space. And then, as always, we wrap up with a couple of stories we can't let go of, including truly one of the dumbest lawsuits in the history of the legal profession. In addition to today's episode, I also wanted to mention that I will be getting out on the road a little bit coming up. While you are listening to this episode, I will be in Salt Lake for the Fintech Exchange event being put on by the University of Utah. Very excited for that. Hopefully I'll get a chance to talk to some of you in person there. And then going into March, I will be out on the road with lots of different events. I think most notably is Fintech Recap, which is at the very end of the month. Very, very excited. Not so much for a trip to Vegas, but excited to explore a different hotel, the Mandalay Bay, and excited for many different speaking engagements, as well as just an opportunity for a little fintech and banking reunion. So if you'll be out on the road, I will be kind of providing more details in the newsletter on where I'll be. Would love to set up opportunities to talk to folks in person, and can't wait to come out of hibernation and get back out on the road talking to folks in person. So with that, I'm very, very excited to take you into another edition, the January edition, of Fintech Recap with Jason Mikula. This is Fintech Takes, the podcast keeping you in the loop on all the latest fintech trends, news, and ideas. I'm Alex Johnson, creator of the Fintech Takes newsletter, your host and self-confessed fintech nerd. Let's go. Okay, Mr. Mikula, into 2026 we go. How are you?
I'm doing well, and after seeing the video you posted of our last chat, I am wearing a shirt today and not a hat. if anyone is watching this on LinkedIn,
yeah, watch it on LinkedIn. Catch us on YouTube. Jason is dressed up for this one. I myself have a hat and look like I've been traveling all week and I'm exhausted, which is true, but that doesn't stop Fintech Recap from recapping the last month or so in fintech. Jason, we were going back and forth on the outline, and it was like, what of the 9,000 crazy things do you want to pick off and talk about this month? Like, I don't know that I remember a recap outline where we had so many choices and had to just like cut, I would say, hours, decades of content off of this episode when we were trimming down the outlines. Crazy.
And we already did a bonus episode that took out an entire very long chunk that would have been in the January recap.
We're not even talking about Contigo. If you want Contigo content, we have that for you. It's its own dedicated episode, which I was happy that we did. But you're right, like, we're not doing Contigo. We're not even really doing banking as a service or going to BaaS Island, and yet there's just still so much news. Plus, Jason, I am delighted at a suggestion you made. You discovered that in our group chat, you and I are careful watchers of the show Industry on HBO. And so a new segment here on Fintech Recap, feel free to skip forward if this isn't your jam, is what I'm calling Industry Watch. This is not in any way related to financial services, although it is related to financial services, which we will talk about. For anyone who's not familiar, Industry is a show that's been running on HBO. I believe it's in its 4th season now. It stars a wonderful ensemble cast. It was created by creators who sort of come from the world of, let's call it, high finance. And so it has a very sort of insidery view on all things Wall Street, trading, investment banking, but also, Jason, probably giving you Vietnam-like flashbacks, like the overlap between Wall Street banking and fintech and consumer finance. The show is sort of purposefully dialed up to 11 in terms of the amount of drama. I cannot stress enough that you don't want to watch this show with your kids or your parents.
No, definitely not. No.
Not that kind of show. And if you are watching the show and have not caught up to the latest episodes, this is your spoilers warning. But Jason, just to start, what is your experience watching this show? Do you just laugh uproariously the whole time?
So I have watched the prior seasons, which, as you mentioned, definitely have more of a Wall Street vibe, although the show is primarily set in London at the fictionally named Pierpont, which I assume is a reference to John Pierpont Morgan, but
I'm sure you're probably
making that
right.
up. Yeah.
Yep.
And the prior seasons definitely gave me a bit of a flashback to this very fictionalized, dramatized, Goldman Sachs-esque culture, which I was, to be clear, very much on the periphery of,
right.
In the safe confines of the 28th floor where Marcus was.
Yeah. You guys were wearing blue jeans and all that kind of stuff. Yeah.
There's a different story there, but yeah, only certain people were allowed to wear jeans, and I was not one of them, but I did anyway. So definitely some flashbacks there in prior seasons. I had not realized that a new season was scheduled, and somebody DM'd me on Twitter, on X, and my partner also enjoys watching this show. Sure. There's some stuff we watch together. There's some stuff that is, separate viewing.
Yeah, I wish I could get my wife on board with this one. I find it very unlikely. So I'm happy for you that this is a joint show.
And, in the first scene, the first 5 to 10 minutes of the first episode, I was losing my shit because, and Alex already gave the spoiler warning, but a reporter for a fintech and banking publication called Fin Digest basically stalks and follows a assistant who's working for Tender, which is kind of a weird name, and I wish they had picked something else, but whatever.
Me too.
Because he's investigating their financials, and he ends up going home with her, and she's kind of out of it, and I'll leave it there. Yeah. And then in the morning, he asks her, starts trying to ask her questions about Tender, and she freaks out and kicks him out.
Yeah.
I
that's literally the opening scene of the first episode.
The first episode.
Yep. And Tender is, Jason, just keep going. Tender is, I'm sure you maybe saw echoes of yourself in this intrepid investigative reporter, because Tender is a payments company, an online payments company that is that this guy is investigating, that I think ends up being kind of the centerpiece, I guess, of this season of the show. And I mean, it's weird because you watch it and you're like, who? This is my field. Which company is this based on? Because this is a online payment processing company, sort of equivalent to a PayPal or Stripe-esque sort of company that is making a large amount of its money processing, let's call it sort of sketchy transactions for merchants and sort of the adult entertainment and presumably other sort of gray areas. And there's basically a schism at the company where one of the executives wants to sort of pivot and one of them does not. And the one who wants to pivot sort of wins the internal power struggle. And the plan is to pivot from being sketchy online payments company to a wealth management company in your pocket global neobank. I when they were describing the pitch for it, there was like a little presentation that was just like straight out of every neobank pitch deck I've ever seen. It was spookily accurate. And all of the characters in the show are sort of like latching on to different parts of this company, and it's sort of like hidden and possibly dark past as it tries to pivot into something cleaner.
I mean, it feels like it is Tender is a amalgamation of Revolut and also Wirecard. Wirecard, and particularly in the EU. I mean, Wirecard was a gigantic story because it was a huge company in Germany. Well, I mean, across the continent, but it was very much viewed as this like homegrown success story. But like, oops, actually, it was a lot of fraud and possibly like a Russian intelligence operation. Like, if you want to go down that rabbit hole, that is a very fascinating story. And then I say Revolut because in industry, there's also a sequence about how Tender wants to get its UK bank charter, which Revolut has been struggling to do for many, many years, as well as a plan to acquire an Austrian bank, which at various times Revolut has pretended it would acquire an American bank, although in real news, it's now pivoted and said it may apply for an OCC charter. I guess don't want to spend all our time talking about fiction, so I have one question for you.
Fine.
And I'm terrible because I don't even know the character's name off the top of my head, but would you hire Kit Harington to be the CEO of your fintech?
Okay. So this is a great question. Again, for those who don't watch, Kit Harington, I don't remember the character's name either. Henry, that's what his name is.
Henry, he's the son of like a lord or something. A wealthy, so, landowning family.
Yeah, and this show being set in the UK, it really does loop in like the UK aristocracy and like kind of like government aristocracy overlap. So that's pretty interesting. But yeah, Henry, played by Kit Harington, who looks like he's having just a ton of fun doing some non-Game of Thrones stuff now, is married to one of the characters from earlier seasons, is this sort of like very wealthy, aristocratic, former politician who in episode 2 of the season sort of spirals into a very dark, depressive episode, only to get pulled out of it by his wife, who then helps him get the new CEO job at Tender. Short, to answer your question, no, I would not want him to be the CEO of my company. I thought like they really short-circuited the process of searching for a potential new CEO without really kicking the tires on, like, if you've watched any previous seasons, like, you know, this is like not the right person to be hiring, not the least of which is because, and they did show this in the 3rd episode, when he's sort of meeting with the company's like leadership team, his wife is there too, and he's like hired her as a consultant, and multiple like members of the board are like, I'm sorry, why are you here? And he's like, oh, well, we hired her as a consultant. Like, it already is going very bad. They are like leaning into very bad directions, and there's inappropriate workplace conduct, which I won't get into. So like there is a lot of not good already within the first like 5 minutes of his appointment as the new CEO of Tender. So I don't feel good about it, Jason, to put it lightly.
Also, I would add, it's a publicly traded company. So, I mean, I guess the board did vote to have him become the new CEO, but I guess...
Well, it was funny. I mean, it lends itself to a lot of interesting questions like, is this how business is conducted in terms of looking for connections to like the government and aristocracy? Probably, I would have to say that especially at this moment in 2026, that feels very on brand, not just in the UK, but obviously in the US and elsewhere. I have to ask, like, another question I have, that's the other sort of half of the show, is how long does it take for short positions to pay out, is kind of another really interesting question here. So the other sort of characters in the show are trying to short Tender and are trying to like encourage all this investigative reporting that's happening. But I mean, Jason, this is not totally disconnected from what you do. I don't think you're in any way as sketch as the investigative journalist who's portrayed in this show, to be totally clear. But it rhymes with some of the things that you at least are familiar with in your job. Like, what do you think of like the shorting the company, investigating the company? Wow, I dropped this great investigative report, but no one seems to care. Like where are you emotionally on that storyline?
I'm not going to profess to be an expert in like the market mechanics of short selling. Obviously, in real world, we've seen Hindenburg Research, which no longer exists, and I forget why they no longer exist.
The guy just closed down shop, yeah.
But like basically try to pursue a similar strategy of we're going to do deep investigative work about companies that we believe are doing something wrong, right? I mean, they covered Square and particularly like Cash App from like an AML perspective. There's also an Indian company I want to say that they had like a deep dive on. But to your point, just because you investigate and publicize, even when you have evidence and receipts of wrongdoing, that does not necessarily translate into shareholders, the stock market reacting and saying, "Oh, like we're going to dump this stock and it's going to go way down, and the short seller is going to make all this money." So it's going to be interesting to see how Harper, who's sort of the character that is has the thesis of shorting Tender, how that plot line is going to play out, and whether or not she's actually going to be successful. But should we talk about real news rather than fictional news?
I feel like we should. I mean, there's so much, and it does rhyme with a lot of what we've been talking about. So let's get into it with a story first that I guess maybe it's a little too recent to show up in fiction, but like Industry Season 5 or Season 6 may cover this exact area. We should talk about crypto market structure fights and stablecoin policy drama, because there's been a lot of it. Jason, just very briefly to recap, because I know you've been following this story as well. The U.S. Congress has been working on market structure legislation, which is actually the much more important sort of component, I think, to legislation and regulation of the crypto ecosystem. Obviously, we had the Genius Act last year that very specifically focused on sort of enabling payment stablecoins. Market structure is sort of like, and we also have to go in and clean up all the other messes that are happening in the broader crypto DeFi ecosystem. So it's a much broader effort to try to apply a regulatory framework to everything in crypto and DeFi. That includes adding clarity, and clarity is the name of the bill as well, adding clarity to a number of sort of ambiguous questions that have sort of developed over the last year. The biggest and most contentious of which is, should stablecoins be allowed to pay out yield? Now, under the Genius Act, as I'm sure all listeners know, the Genius Act prohibits payment stablecoin issuers from offering yield to incentivize customers to hold them. However, it left a gigantic loophole in place, which allows any other party, including affiliated parties like exchanges or wallets, to offer yield to hold stablecoins. And one of the main beneficiaries of that loophole is a company called Coinbase, which you all might be familiar with. Coinbase has for a long time paid out rewards for customers that hold USDC on their platform. This is both smart strategy and smart economics by Coinbase, because they have a very lucrative distribution deal with Circle. They are also an investor in Circle. So they make money when more USDC is minted and in circulation. And they take some of that money and reinvest it in rewards for customers holding USDC on their platform. That is currently allowed, both because the Genius Act has not been implemented, but also even once it is, it will still be allowed because it is not Coinbase actually issuing the stablecoin. Banks, as you and I have joked about before, got involved in this fight way too late. They did not succeed in closing this loophole when Genius was being negotiated on the Hill. But they have, got to give them credit. They have really circled the wagons on bringing a lot of lobbying effort to bear on Capitol Hill. And in fact, from what I understand, as we got down close to the sort of countdown of when clarity was going to be marked up and voted on and taken to the main chamber for a vote, banks had actually managed to kind of outflank Coinbase on this. And I think one of the reasons is that the crypto ecosystem is actually very large and diverse, and the Clarity Act contains a ton of other stuff that other non-Coinbase actors care about, right? Governing how KYC is going to work for DeFi applications, and governing when the CFTC is going to oversee certain parts of the ecosystem versus the SEC, which is a question of, is this a commodity or is this a security, and how do we separate those two? So there's like a whole bunch of other stuff here that is not just this very narrow stablecoin fight. So what essentially had happened was banks had gotten to a point where it looked as though they were going to be able to close off the loophole that Coinbase and others use to allow yield to be paid out on payment stablecoins. And Coinbase at the last second freaked out and announced that they were not going to support the bill as it was written. Coinbase is one of the largest individual kind of players in the crypto lobbying space. They are one of the main funders of crypto trade associations. And so when they said they weren't going to support it, it basically scuttled the legislation at that point. And Jason, I mean, I feel like we've spent the last month or so sort of like observing the fallout of that. I can tell you that almost everyone else in the crypto ecosystem was pissed at Coinbase for doing this with very little consultation or advance notice. Lots of legislators who had been working with Coinbase and others in the crypto lobby to carefully shepherd this forward were also pissed. I think the quote was, these people don't like having their time wasted, which I think is a very, very fair critique. And Brian Armstrong made his way to Davos, Switzerland, for the World Economic Forum.
As one does.
As one does. Took a little time out of his schedule to go to Davos and was all over television, being interviewed everywhere by everyone on podcasts, basically continuing to say the same version of the same thing, which is that banks were screwing over ordinary people by voting to uphold a system in which banks are able to lend out customers' deposits without customers' permission, which he believes is both unfair and highly risky, not acknowledging the basic reality that what he's describing is the fractional reserve banking system, which has existed for a very, very long time and is the dominant way that most banking, not just in the US, but around the world, works. Jason, I have to just read a quote from a Wall Street Journal story that came out today, very, very recently, reporting from Davos. Are you ready?
I'm ready.
Okay. Quote, Brian Armstrong, CEO of the biggest U.S. crypto company, was having coffee with former UK Prime Minister Tony Blair, parentheses, as one does, at the World Economic Forum in Davos last week when JP Morgan Chase's Jamie Dimon cut in. You are full of shit, said Dimon, a longtime crypto skeptic who previously called Bitcoin a fraud. His index finger pointed squarely at Armstrong's face. Dimon, in a nutshell, told him to stop lying on TV, according to people familiar with the conversation. In appearances on business television programs earlier that week, Armstrong had accused banks of trying to sabotage legislation that would set a new regulatory framework for digital assets. Jason, so much drama, so much entertainment. What do you think of all of this?
So I will admit I've been following this story at somewhat of a distance. I had other stuff going on in January.
Yeah.
And so a lot of my consumption of this came via podcasts, specifically the Banking with Interest podcast, which is Rob Blackwell. And he had an episode with Brendan Peterson, who's a reporter for Punchbowl. Yeah, Punchbowl.
Yep.
Who is like covering the nuts and bolts day to day on the Hill stuff, which I'll be honest, that goes like a little bit more than I really care to follow of like, who's mad at whom about what, like minuscule provision
the parliamentary strategy of where, totally. But it was a very good episode and people should listen to it because it gives a blow by blow of like how this all fell apart.
I mean, I think for perhaps for people that are more in our world, and when I say that, I mean maybe more like banking and fintech world, as opposed to like hardcore, very much focused on the crypto landscape. I think the point you made, and this also very much came through in that episode, is to use a classic political commentator phrase, crypto is not a monolith, right? You have different factions that want different things. And I do think, and I'm guilty of this as well, of sort of treating Coinbase or treating Brian Armstrong as, the co-founder and CEO of Coinbase as sort of an avatar for the crypto industry writ large. Some of the analysis in that episode that I'm going to attribute to Brendan, I think he said something along these lines, or maybe it was both him and Rob, was essentially that Coinbase expended an immense amount of political capital in the process of the sort of drafting of this bill that ultimately was basically wasted by then nuking it on what is my right sports metaphor here, on the 10-yard line?
Yeah, that's right. About to score a touchdown and just decided to spike the ball. Exactly. This episode is brought to you by Plaid. Approving more borrowers shouldn't mean blindly taking on more risk or adding more friction. The problem is that traditional credit data is limited, and cash flow data alone doesn't always tell the whole story. Plaid helps lenders see the full picture by combining real-time cash flow data with insights from the financial tools people already use every day. Those signals come back in seconds through a low-friction experience trusted by about half of U.S. adults. That means you can approve borrowers who are stronger than their credit file suggests, spot risk earlier, and grow without loosening your standards. Learn more at plaid.com/FTT.
To some of the points you made, I find this conversation immensely frustrating, as I think you do as well, because both sides, or there's more than two sides, there's many sides. But if we characterize this as like bank versus crypto, which is an oversimplification, but both sides are being utterly disingenuous with the crypto side, sort of as represented by Coinbase Brian Armstrong, pushing this narrative that somehow blocking this rewards loophole, depending on your perspective, whether or not it's a loophole, but sort of stopping the ability of non-issuers to pay yield is a quote-unquote bailout to the banks, which just makes no sense.
No.
Like, no one who understands anything about how the space works would ever believe that argument. It just becomes, a cartoon to put on TV, which is, basically what it was. But conversely, on the banking side, it's a little bit of like Chicken Little, the sky is falling. If we allow yield, all Main Street small business lending is going to collapse because $6 trillion gajillion worth of deposits are going to leave the banking system and go into this, stablecoin world. And neither of those are true. Which, there's sort of the political and messaging battle, which is it is a real battle, right? In as far as how you try to persuade, whether it's voters or whether it is congressional representatives, senators, and whatnot. And then there's also like the policy world that I guess much fewer people actually live in and understand.
No, I think that's very true. I mean, just to hone in on one point you made on the bank side, all of the bank CEOs were asked about this very early in their earnings calls as all this was happening, right? Because the big bank earning calls were happening at almost exactly the same time that the market structure legislation was falling apart. And so it was like a very topical question to ask Brian Moynihan at Bank of America or to ask Jamie Dimon and the team at Chase. And all of them used the same very frustrating talking point, which was that if stablecoins are allowed to offer yield, up to $6 trillion would be at risk in the banking system in terms of deposits. I looked into where that number came from, just like because I wanted to understand where this is being sourced from. It is sourced from a report that came out of the Treasury Department, but the $6 trillion number, that is actually the total number of deposits held in non-interest bearing accounts at U.S. banks, right? So that is like checking accounts, now accounts, prepaid. And so essentially what the bank CEOs are saying is if stable coins are able to offer yield, all the money held in US checking accounts could leave. Like, what does that even mean? Like, that is completely just nonsensical. There is no way that just because Coinbase is able to pay out yield, I and my brother and my dad and my mom and you and Kia Haslett are all going to like move our money out of our checking accounts entirely into Coinbase. Like, it almost speaks to the lack of confidence that banks have in the value proposition that they offer to customers, that they even entertain the idea that like some new entrants in the crypto ecosystem paying yield on money held in stable coins is somehow going to disrupt the like operational account that millions of consumers and small business owners have with either community banks or large national banks. Like, it just strains credulity in a way that I don't understand. And then to your point about the Brian Armstrong side, I mean, all of it is so disingenuous because it's not an accurate depiction of how banking works, right? I mean, like, he was at Davos talking about fractional reserve banking as if it's a conspiracy theory. And there were multiple people in the crypto ecosystem who were like, yeah, this is outrageous. Like, breaking news, they have, released this thing that reveals that suddenly like people are getting screwed and your deposits without your permission are being lended out. Like, that is just not accurate either. And so to your point, no one is really telling the truth about this. And it also, and this is the last thing I wanted to talk about with this story, it also is like weaving its way into like a broader set of political kind of back and forths that are happening seemingly kind of with the White House sitting at the nexus of it, that I find really fascinating, because one of the folks who works in the administration, who works on crypto policy, has tweeted several times about how like banks better get on board with the current, market structure legislation or else. And the or else seems to be maybe the Credit Card Competition Act, which has suddenly sort of made a resurgence and then an appearance back in our lives, or perhaps a 10% cap on credit card interest rates, which is something that the president very just sort of from the hip kind of mentioned was a thing they were going to work on. Jason, what do you make of like the larger political wrangling around like punishing banks, affordability, credit card competition, and how it's overlapping with stablecoins?
That, I mean, to me, that's kind of the most interesting story.
Yeah.
In the sense that, I mean, CCCA, like, seemed to resurface out of almost nowhere.
Yeah.
And the way that some people were talking about it was essentially how you're describing it is kind of like, to put it more charitably, a bargaining chip. To put it less charitably, blackmail? Question mark?
Like nice credit card business you have there, would be a shame if anything happened to it, was sort of the reading between the lines. Yeah.
And I think both the Credit Card Competition Act and this fanciful 10% cap on credit card interest rates, politically, again, from a political messaging perspective, speak to something that the current administration has been struggling with, which is affordability. So the timing is very interesting, because it's like, okay, crypto industry, overwhelmingly is now sort of perceived fairly or unfairly as like a right-coded or a Republican-coded industry. Although there are Democrats both in the House and the Senate that are that are and continue to be pro-crypto. And sort of the timing of these sort of bargaining chips coming up, so administration can say, hey, like, we're pursuing these measures that ostensibly are, pro affordability, while also using them as part of this sort of very complex and what appears to be interwoven sort of bargaining around particularly this like rewards loophole, and then other other components of clarity of the market structural legislation. Now, does this all just become so convoluted and complex that it like collapses and nothing gets over the finish line? also totally possible.
Yeah. I mean, that's the thing is like, if you're sort of asking like, well, where are we now? Where are we going? It's really tough because kind of going back to the quote I gave earlier, like these people don't like having their time wasted. You don't get unlimited shots on goal on Capitol Hill, I think is one thing that's important to keep in mind. Like, as much as I don't really like to give the impression that Congress gets any of the things they're supposed to be doing done, they are busy and there are a ton of different priorities that kind of make their way through these committees. And like, they can't just forever and ever and ever in an ongoing fashion keep debating crypto stuff. Like, they have to sometimes move on to other topics. And so the sense I get kind of following the political coverage of this is that crypto market structure legislation has kind of been pushed a bit to the back burner and will eventually kind of come back, I'm sure, and will, get another vote at some point. But this is one of the reasons that I think a lot of folks, including people inside the White House, were mad at Brian Armstrong and Coinbase is they had this at the 10-yard line, to your point, to use your sports metaphor, and the ball got spiked, and like they're not going to score a touchdown, and it's not totally clear when they're going to get another chance to. So it does bear continuing to watch. We won't give any more credence to the 10% cap because that's such a stupid policy that is very, very unlikely to actually manifest as a real thing that happens through Congress. That probably isn't even worth discussing. We will revisit maybe some credit card topics in a minute, but before we do that, Jason, can you very quickly talk us through what's going on in, I think what we used to call the window is open, but now maybe we're renaming it.
I was working on drafting a piece on this for my newsletter, which when this airs will have been a couple of days ago. Mm-hmm. And I'm like, this charter window metaphor, I'm not sure it works anymore when we have so many applications. So yeah. I'm playing around, but is it a charter waterfall? It kind of feels that way.
Charter waterfall. Okay, I like it.
So setting aside all of the OCC trust charter applications, many of which are actually tied to stablecoins and stablecoin issuers, we've also seen quite a number of traditional, full service or deposit taking charter applications, sort of moving through that pipeline. So Nubank, the Brazilian neobank that also is quite popular in Mexico, has recently received conditional approval for its OCC national bank charter. Mm-hmm. Ford and General Motors have received approval for deposit insurance tied to their Utah Industrial Loan Company charter applications. Mm-hmm. I think it is worth pointing out that GM previously had an ILC and it blew up during the 2008 crisis.
It didn't. Yeah, that was an actual bailout, by the way.
Yeah. So it got bailed out, but the government actually made $2.4 billion on its equity stake when it sold it. And then that bank became what is now known as Ally.
Yes.
So I realize, bailouts are bad, but in that case, it preserved an institution from failing and the taxpayers actually made money.
Yes. Well, and also ILC advocates can argue that like, it didn't fail. And it's like, no, it didn't fail. Something a little bit more exciting happened, but it didn't fail. So maybe ILCs and all these new charters are safe, Jason. Maybe there's no reason to worry.
No, but we're going on a tangent now, but to rescue it, it had to convert from an ILC to a typical commercial bank and get a bank holding company so it could access Fed emergency liquidity facilities, which is actually somewhat similar to Goldman and Morgan Stanley in that same time frame, just sort of overnight transitioning from the structure they had to all of a sudden being commercial banks that could tap like Fed discount window and other Fed emergency facilities.
Yeah.
I will plug your colleague Kia's newsletter on the ILC topic, which provides a lot of great history about like, what is this thing? Where did it come from? Why does it exist?
Yep. And she'll be writing more about ILCs, I think, over the next couple of weeks because she's really sunk her teeth into it. But it's that's one of those ones where, and you already hinted at it, and I think there's more examples that you want to share. But just to mention really quickly, there's a federalism is fun, I guess, is the sort of like tagline for this whole discussion. In that, you have federal charters, which you mentioned some of, right? We have the national trust banks, which have become a big story over the last year. A bunch of those applications actually have been conditionally approved by the OCC and are moving forward. You have sort of standard de novo national banks that are coming through the OCC, again, some of which have been conditionally approved, like a new bank or Erebor. And then, of course, you have state level ones. And the concern with the state level ones has never been that like, oh, the state of Utah or maybe the state of Nevada, which we'll talk about in a second, wouldn't be willing to approve this company getting one. The challenge is that you do end up needing some level of federal approval to practically make it work. And in the case of an ILC, you need the FDIC to kind of sign off on it. And so that's why we haven't seen as many of these over the last 4+ years, is even though the states might have been cool with it, the FDIC under previous administrations would not have been. So keep going on ILCs.
Yeah, I mean, and Kia, I imagine we'll talk about this as well. Like the ILC deposit insurance, which is necessary to actually operationalize a bank, deposit-taking bank, became explicitly partisan. And I actually, in my head, I remember that as being like a post-financial crisis thing, but the actual moratorium on FDIC granting deposit insurance to ILCs was in 2006. So it actually predated the 2008 sort of mortgage crisis. And then for a long time after that, you just saw no ILCs. And then it became kind of like a Dem Republican thing, which Kia can unpack more for us and explain in greater detail why. But yes, Ford and GM got their deposit insurance approvals. PayPal also filed to form an ILC last December.
Here they come. Yeah.
So PayPal wants a bank. Bunk, the Dutch neobank, which actually, when I was doing some research on Bunk, I had not realized that it was the first de novo in the Netherlands in 35 years.
Wow.
So Americans who are complaining about a lack of de novos, come to the continent. There are not a lot. There's not a lot of de novos here.
Yeah.
Bunk had originally filed for an OCC charter app in 2023. You and I talked about it.
Well,
I
remember.
re-listened to that episode, and I think we got it exactly right then, and I think everything we said still applies. But I think the one that we should talk about in a little bit more detail is buy now, pay later lender Affirm. So Affirm announced it is going to apply, or has applied for, a Nevada ILC charter, which I found interesting. I mean, most of these ILCs are in Utah. Both Nevada and Utah lack a usury cap, which is one reason why those states are appealing. At a more practical level, there's only a handful of states that actually do ILC charters. I want to say it's like 5 or 6. And so pretty much all of them are in Utah or Nevada. I think like Hawaii still has one. And I believe like California might have one or two. In Nevada, you have Beal Bank, Toyota, so another an auto company, Eagle Mark Savings Bank, which I had not heard of, had to Google and realized it is actually owned by Harley Davidson, the motorcycle company.
So another auto one,
Yes, auto-related one. Affirm would become the 4th ILC in Nevada. In some very quick research, I guess there's a perception that Nevada is like more business friendly and or maybe quicker to organize than Utah. If anyone listening has like additional commentary on why Nevada versus Utah, I would be intrigued to hear why.
Yeah.
It's also worth noting that in Affirm's statement about applying for the charter, the company positioned it as complementary to its existing bank partnerships. And the specific quote there is, quote, "The proposed subsidiary would complement Affirm's current business and bank partnership models, including by providing greater flexibility and diversification to help advance responsible innovation in financial services," end quote. And that's, not unusual. When Lending Club acquired Radius, it didn't cease doing some of the other funding mechanisms it had used prior to acquiring a deposit-taking bank. And so I suspect we'll probably see something similar here. For Affirm, very logical move. again, we've seen this from other fintech lenders that were not banks. So in addition to Lending Club, SoFi, of course, acquired Golden Pacific. If you're a lending business, makes a ton of sense, both from a cost of funds standpoint, as well as from the ability to write your own loans and sort of own your own regulatory destiny. People who've been in the weeds on the bank fintech partnership space will likely
like you and I,
will likely be aware that, at one point a firm was primarily using Cross River to originate loans, and Cross River did get a consent order related to fair lending. A lot of
it was
banks,
a little restrictive of new things they could do with partners. Yeah,
and so if you're a lending partner of a bank, there is always some amount of risk there that something might happen that constrains your ability to scale your business. So by having its own charter, if and when approved, and I imagine it will be, it gives a firm
waterfall, baby.
I mean, per the statement that a firm made, it gives it more flexibility both to tap bank partners to originate loans, as well as to use its own bank charter. That was a mouthful. How do you feel about the ILC universe, Alex?
Oh, it's a good question. I mean, I guess a couple things. ILCs are attractive for a number of reasons, not the least of which is that becoming a national bank is not like something that everyone wants to do, right? I mean, for every one of the like Arabors or new banks of the world that are going kind of for a full national bank regulated by the OCC, there are many, many more who don't want to do that. What I have heard kind of from folks who are familiar with this space is that becoming a bank holding company in particular and being regulated as a bank holding company is not something that's compatible with a lot of companies' business models, particularly if you have a very sort of non-financial services business sort of attached to it. So way back in the day, famously, Walmart tried to become a bank, kind of going through this ILC route. So it's very popular for sort of non-banks or even non-financial services companies that would like to own a bank as a part of what they do to go do this. From a firm's perspective specifically, I mean, I think you hit on it. The optionality, the strategic optionality it gives you is really good, right? Because I would say they're among the best at having sort of built a really strong capital markets business. And so they can tap wholesale secondary market funding very, very efficiently. They have a very strong track record from an underwriting perspective. So it's not like their cost of funds is horrible, but deposits provides a much, much better cost of funds.
I think it's like 7%.
Yeah.
For a non-bank lender, it's not it's, I mean, they're not subprime, so it's much higher than a bank's cost of funding.
Right. And that's a good way of putting it, right? Is that like even a firm who's getting probably the best deal you possibly could through that mechanism is still paying more than deposits, than banks pay for deposits. And so like deposits are just cheaper, even if you're really good at it. To your point about Lending Club, I think is a good parallel in that they kind of treat their secondary market infrastructure and their capital market infrastructure as sort of an overflow on like a drain, right? Where it's like, hey, if we have more than we originate than what we can absorb on our balance sheet or that we can pay for with our own funding, we can tap these other markets and we can kind of like turn the dials however we want quarter to quarter to kind of make the math work. So it's just a more kind of resilient model if you have both bank funding and sort of the secondary markets infrastructure spun up. So I think a firm will continue to do both. I think a point you made that's really good one as well is not only is there risk from a cross-river consent order, like you want to have some redundancy in terms of where you originate these loans. I also think everything happening with Didmica and the ability to like outsource your interest rates from one state to another, like you probably want a little bit of redundancy there perhaps as well. And so I just think like there's a lot of different places where having strategic optionality makes sense for a firm. I will say, just as kind of a final note, we've seen lots of other companies say, oh yeah, we're getting a bank charter, or, we are, we're Plaid and we've reached this deal with JP Morgan Chase, but it's not going to have any like pricing effect on our customers. A lot of times these are things you say at the beginning of this process so as to not scare anyone who might be adversely affected. But you can also assume that over time, like just regular market realities will play out. And I would expect a lot of volume to shift over to a firm's ILC over time, much in the same way that like Square has moved over a lot of its Square and Cash App business to its own ILC over time. Like, this is the most efficient way to do it. And as you scale it up, and as you get out of kind of the de novo period where regulators are a little bit more cautious with what you're able to do, you will start to see more volume, I think, shift over there at times. And that's going to be consistently true, not just with Affirm, but with the other ILC applicants that you mentioned.
I think that's true. I mean, one small quibble. I know we agree 99% of the time. So it's not clear to me that the ILC would do anything to help with the DINMICA problem, given that it's state chartered.
That's a fair point.
If you were really concerned about that, as my dog downstairs appears to be, you would want an OCC chartered bank where the preemption stuff is more clear.
That's a very good point. And I think the other thing maybe to tie into that's relevant specifically to Affirm that I hadn't thought of as I was talking it out is like, correct me if I'm wrong, but Nevada doesn't really have like a usury cap at all, but Affirm sort of, I've always thought, kind of holds themselves a little bit to like a higher standard than they're required to from like a regulatory rates, fees sort of perspective. And so I guess the point is, I don't get the sense that they would be the one who'd be trying to seek out some kind of loophole necessarily as it relates to this stuff.
Yeah, I think that's right. I mean, as far as I recall, the max interest rate on an Affirm interest-bearing loan is 36%. And actually, its relationship with Cross River illustrates the sort of interesting puzzle pieces because Cross River, based in New Jersey, I believe the max that a firm could write through Cross River was $29.99. So like there's a 30% interest rate cap in Jersey. And so, if a firm wanted to write loans above that 36%, it either needed to use state licenses that it holds, because it does hold certain state lending licenses, and or other bank partnerships. So it is, I mean, to your point earlier, federalism, it's fun.
It's fun. It's not complex. It definitely doesn't keep lots of lawyers employed. So I think like that, I think that it is a really interesting example. And I guess one last question for you on this topic, Jason, is like, where else will we see this waterfall expand? I mean, we talked about ILCs, which are kind of having their moment right now. We've seen more national banks come in. Is there another vector of this that we should be watching?
That's an interesting question. I mean, I suppose we are seeing it to some extent in the merchant acquiring space, which is like very niche and specialty. I know that you and I have discussed the Malpes, the Georgia Malpes, previously.
Sounds like an award that you just mentioned, the Malpes.
Oh my God. I would love to go to the Georgia Malpes.
Me too. I would present an award. At like the Georgia Malpes. Okay. All right. We've got that on the record.
Georgia regulators, if you're listening, have an award show. The business model that makes the most sense to pursue the full service charter is lending. And so what I would go back to is, are there other non-bank lenders where it is, to use my favorite Goldman word, is it accretive to the business to get the charter? You and I, actually in this list, we were talking about de novos. Enova is acquiring Grasshopper.
Yes.
So my former employer, Enova, which is these days, I think it's about 50-50 mix of SMB lending and consumer near prime, subprime. That is a business model where it very clearly is beneficial, again, from a cost of funds perspective, and also from a ability to write your own loans without bank partnership perspective to have a bank. If we look at some other places that are maybe more payments driven businesses, Chime is a topic that we've talked about endlessly. Does it make sense for Chime to have a bank charter? Probably not, given the customer segment it's currently serving.
Yeah, I don't really get the sense they care about going into this, even though the waterfall is raging right now. Yeah.
It's not, I mean, as with Vero, it feels like it does have the potential over time to become a drag and become an albatross rather than a tailwind.
I think that's right.
But speaking of banks and fintechs, there was a pretty big acquisition that it feels like every single person on Twitter and LinkedIn was giving their opinion on, which I decided my voice was not needed. But you wrote about very intelligently and accurately Capital One's acquisition or proposed acquisition of Brex. What's going on there? What's Capital One doing?
Well, so they kind of came out of nowhere because, apparently this deal came together in sort of record time after the initial approach happened. And Capital One is acquiring Brex. So for folks listening, I'm sure you know, Brex is a corporate card and expense management provider, sort of in the same category as a Ramp or a Divvy. They had achieved a private market valuation of $12 billion, which is very big, although sort of probably looks just sort of cute compared to like what Ramp is doing right now. But a very, very large, successful, scaled up fintech company, highly valued, had its ups and downs over the years, is being acquired for a little over $5 billion. There was endless amounts of very dumb commentary on sort of VC Twitter about like, is this a good exit? Is this a bad exit? Blah, blah, blah. It doesn't really matter.
It's almost impossible to tell from the outside.
It is because we don't know like what the liquidation preferences are or like what that stack
who
looks
got
like
RSUs,
for the different investors.
Who got cash bonuses? Like
right. Is this good for employees? If so, when? Like everyone was speculating on it, but like the reality is we don't really know. We do know that just mechanically, despite the valuation, the amount of money that investors put in to Brex is less than $5 billion. So investors will get their money back to varying degrees. Exactly to what degrees, it depends on details that we don't know. Again, that doesn't really matter. The more interesting question, and Jason, I'd be very curious for your opinion on this, because I tried to do some research on this. This was like a main portion of Capital One's most recent earnings announcement. So their CEO spent quite a bit of time talking about it on the earnings call, is like, why is Capital One doing this? And obviously, this acquisition is happening on the heels of the acquisition of Discover, which is now sort of fully done from a regulatory perspective, $35 billion. Capital One now is doing the hard work of like integrating Discover, moving cards over to Discover's network, kind of all of the blocking and tackling that comes after that acquisition. I guess I was a little bit surprised that they would plunk down, $5 billion is not a ton to Capital One, but it's enough that you have to be able to justify it to your investors. On Brex specifically, the way that Rich Fairbank at Capital One talked about it was really about bringing more commercial payments volume over to Capital One. So he talked about it very much as the CEO of a payments network, I would say, more than a bank. So even though there were some talking heads on Twitter who were talking about, Brex has all these deposits and all of these other things that might be attractive to Capital One, the sense I got kind of reading it straight from the horse's mouth in the earnings call from Capital One was that they view this primarily as a payments volume business and a way to sort of accelerate growth on that side. What did you think of this?
Yeah, that I also saw some of the commentary about this is not a deposits deal. I mean, Capital One already has like $500 billion of deposits. Like the 13 billion that are managed by Brex, it's a rounding error. Like that's not what this deal is about. And further, those deposits, if they're bank deposits, are probably legally belong to Column, Brex's bank partner, or there are money market funds that like Brex manages on behalf of its customers as well. But like that's not what this deal is about, obviously.
No.
That I'll admit, I had not like dug deep into the details because so many other people had already opined on it. As a payments deal, the argument I would try to make is to further leverage the Discover acquisition, right? So it's like, okay, and I'm thinking through this in real time. So if this is dumb, just tell me. But if I'm Capital One, can I acquire Brex, eventually migrate and have those cards issued on the Discover network, which is now a tri-party, it's a tri-party closed loop network to which Durbin wouldn't apply on the debit side. It wouldn't apply anyway because it's commercial, not consumer. And basically build like a nice chunky interchange business based on corporate card spend. That, you can see the pieces, how those pieces could fit together in sort of like a medium to long-term time horizon of, to your point, the hard work of CapOne digesting this Discover acquisition, and then, the hard work of like leveraging the Brex acquisition, which my understanding is, at least the statements say, Brex is going to continue to operate as an independent entity with the existing CEO, whose name I'm forgetting, Pedro something. Continuing to be CEO. But can Capital One over time sort of integrate or leverage Brex enough to take advantage of the other assets Capital One has, whether that's on the network side, that Discover, or SMB lending and sort of other business lines that Capital One has available in-house that Brex either does not have at all or has through its bank partnerships.
Yeah, I think that's exactly the way they're thinking about it, is like, we have the network, now let's try to run as much volume through it and as we can. And I think that if you look at Capital One's business today, it's pretty interesting actually, because it's obviously dominated by consumer card. That's their primary business. On the business side, they actually do very little commercial, like true commercial banking or commercial lending, right? They have some, but they don't do nearly as much as most banks that are kind of in their general zone of size, right? Like most banks their size have massive commercial banking, treasury, investment banking, commercial lending businesses where they work with large corporates to do a whole bunch of different stuff. I think that one of the dynamics we're seeing, and this actually was, I think, one of the dynamics that informed the Brex partnership deal with Fifth Third Bank, which like just happened. It was just announced like not that recently, not that long ago. That I think was much more about, look, we Fifth Third have a great commercial banking and lending business, but the one like weak spot is we don't have a very good commercial card. And it's embarrassing to companies when they work with Fifth Third, when they're going out to dinner and they plunk down their, kind of dorky Fifth Third card that doesn't work very well and isn't in any way interesting or differentiated. And then they have to fight with their assistant and with, the finance team about the expenses that they're submitting. Like, it's just a clunky, bad part of what is overall a very lucrative, valuable relationship that they have with Fifth Third at a commercial level. Why don't we fill that very narrow but annoying gap in our product set with a really great corporate card expense management system? So like most bank interest, I would say, in the corporate card expense management space is this can be like a crown jewel of a very profitable commercial banking and lending business. That is not Capital One. Capital One does not have that business. I don't really get the sense they want to grow it that much. They view this as a way to grow, again, spending volume on small business credit cards and bring more of that volume onto their network. Now, the thing that I find interesting and potentially challenging for them is Brex actually already tried this, right? Brex tried to expand from serving just high growth startups to serving small businesses more broadly, right? This was a thing they tried to sort of expand into during the pandemic. And embarrassingly, they basically had to offboard all of the small business customers that they had got and basically say, yeah, sorry, our software is actually really not like tuned to work with just your average small business. It's very much specifically built to work with the types of companies we are and the types of companies we understand, which are venture-backed, high-growth, like startups, right? And so I think it'll be really interesting as Capital One tries to sort of integrate Brex. I mean, I think Brex can really help them grow their card volume in that high-growth startup sort of emerging, like becoming large private companies space, like kind of figure where SVB used to live. Like they can grow in that space, and Capital One can get a chunk of that business through Brex. Brex already has a large chunk of that business. I think, more skeptical that Brex is going to, from a product perspective, because its product is pretty tuned to that segment of the market. I have more skepticism that that product is going to help them suddenly unlock an ability to get a bunch more just generic small businesses, right? Like, does an HVAC installer in Cleveland, Ohio, look at Brex and go, this is exactly the solution that I need? Doubtful. I don't think it really does. And so I don't know that by itself this solves that problem. Now, Capital One also talked a lot in its earnings call, and I think this is maybe where Cap One's own biases come into play a little bit. They talked a lot about being impressed that Brex had built its own tech stack internally, and we're acquiring this great technology and these great technologists, and this is going to be great. Well, you have to hang on to those technologists, which is not going to be easy. And this speaks to, like, we'll continue to let Brex run independently. Matt Janiga on Twitter had a great story he was telling about when Capital One acquired ING back in the day. And apparently the ING executives gave Rich Fairbank at Capital One like a butterfly that had like been pinned inside like a glass case, and they were like, "We're a butterfly, please don't crush us," and that like made a big impression on him. And so like there's kind of different models for how you acquire and integrate a company, and I guess the hope is that they will treat Brex more like a butterfly that they don't crush, and they're able to keep more of their tech talent. But I also think it kind of maybe misunderstands why companies win today in fintech, right? And obviously the comparison here is Ramp. Ramp doesn't build almost any of their own technology. They build products using other technology that they acquire. And Ramp, despite being newer, I think has arguably been, not just from an investment perspective, but from like a growth customer perspective, more successful than Brex. And so like, Rich Fairbank's explanation of, we wanted to get Brex partially because they have this great technology. A follow-up question I would have asked if I would have been on that earnings call would have been, well, yeah, but aren't they doing better than Brex? And their advantage has nothing to do with having grown their own technology. So I think while strategically, if McKinsey was drawing on a whiteboard the like strategic synergies of this deal, that part makes sense. I don't know that the actual mechanics of fitting these different businesses and products together make as much sense, maybe as Rich Fairbanks has been told. And so I'll be curious to see how that actually plays itself out once we get to the hard work of integrating these things.
This will definitely be one to watch, and you definitely have a more fully developed thought process on it than I do.
I wanted to comment on it without like being the first person to rush to Twitter to comment on it, if that makes sense. So I did take my time to actually look at it, but it's hard, right? Because it's like I admire Capital One for taking swings, right? Like they did the Discover thing, which everyone kind of liked.
And they got it done. At the time, it was like, I would say less than 50-50 that deal was going to go through. And it hinged on, frankly, the election, right? And
yeah.
Rich made a bet, and the bet paid off.
Totally. So like, I mean, they're not sitting still. And if I was an investor in Capital One, I would be just enthusiastic at the degree to which they're not trying to just like rest on their laurels. But I think this one, it just strikes me as kind of a like, I've been on kind of a hot run at a blackjack table, so I'm going to, split eights, and it's like, okay, basic strategy.
I don't know what that means. Well, I don't really know what that means, but yeah,
don't split eights. But like if I'm on a run and I'm feeling myself, I might do it anyway. And this reminds me a tiny bit of like you've been on a hot streak and you are kind of riding that high a bit. But again, a lot of it remains to be seen because the strategic fit makes sense. The practical execution fit maybe slightly less. Mikula, before I let you go, we should talk about what we can't let go. And
yes.
I strangely filled in the outline with my choice first, and yet I'm jealous of the one that you picked second. So why don't you go, and then I'll follow you.
I mean, this one really, it's for both of us.
Thank you, Jason. Thank you.
And I have dubbed it FinTech's dumbest lawsuit.
I love it.
This lawsuit has actually been going for a while, and it is cash flow underwriting startup Prism Prism Data, or is it just Prism now?
They'd mostly just go by Prism, I think. Yeah,
Prism versus scam company Tomo Credit. And I do think that it is fair to describe it that way.
It is entirely a scam. It is not, just to be 100% clear, not a real business.
And I mean, I wrote about the trademark infringement lawsuit when it was filed like quite some time ago.
Yeah.
The TLDR is Tomo Credit pretended to launch a cash flow underwriting product, which is ludicrous because its own credit card offering failed when it repeatedly defaulted on its debt facility provided by Silicon Valley Bank. It pivoted to pretending to sell this as a cash flow underwriting score and then called it Cash Score, which was a problem because Prism had already registered that as a trademark. In the back and forth of that litigation, Tomo Credit admitted to fabricating and backdating blog posts to pretend that it had used the term earlier than it had, which is insane. And if you're a lawyer who's filing that stuff, I'm embarrassed for you.
Yeah.
But this stuff already happened. So the new development is that Prism and Tomo Credit reached a settlement in theory to sort of resolve this and put it behind them. But then Tomo Credit, and specifically Tomo Credit's CEO, Christy Kim, basically like reneged on the agreed upon settlement, refused to sign, actually like memorialize it by signing it, tried to renegotiate it, and then this dragged on so long that Prism filed a motion in mid-January asking the court to compel Tomo Credit to comply with the terms of the settlement. And it's just the dumbest, biggest waste of time and resources, and I think really representative of, I guess you could say, like, norms versus rule of law. It's like, okay, well, you technically did agree to this settlement, but then if you're just ignoring it and continuing to use the trademark, in violation of the settlement agreement, like, what is the recourse of the party that's being wronged? And I guess in some sense, that's like a microcosm of life in 2026. There are no rules. Don't apologize. Don't back down. But it is, I will close where I started. It is the dumbest lawsuit in fintech, and there's a lot of lawsuits in fintech.
Yeah, I mean, you cover a lot of them, so that is saying something. But I agree with you. I mean, I guess I'm happy that Prism continues to fight this, just almost for entertainment value. It almost feels like they're like, how much money can we spend on lawyers just to like really document how dumb all of this is? And as an observer, a close observer of this case, I appreciate their continued willingness to try to like dig a well where there is no water at the bottom of this well. I will say the flip side of that that's weird is that Tomo's continuing to violate this like trademark, to like infringe on this trademark for no purpose, because no one is going to buy their cash score because there is no cash score, and it would take exactly 3 seconds of talking to them or looking at it to realize that. So like there is no reason for Tomo the scam to continue to like fight this or in any way like hold out here, because there's no value for them. Like they're not going to make any money doing this because they're not going to be able to trick a company into giving them a dime to pay for a thing that's not real. So like it's almost as if Christy is committed to scamming people. Yeah,
she's
like
committed
it's like
to the bit.
She's committed to the bit as like a lifestyle almost. Like it's more of a lifestyle than it, like there is no rational economic reason to do it, even if you have no morals.
It's an Elizabeth Holmes level of dedication to scamming.
Yeah, but like the most like pathetic and dumb version of it. It's just like there is nothing good at the bottom of this story, and yet I feel compelled to just stare into this deep dark hole forever. It's ridiculous. And I will say, just to close this topic, the judge in this case, Russ Vought, if he decides to maybe get interested in something besides what he's doing, like anyone needs to stop this, because despite the fact that this cash flow part is kind of just silly and nonsensical and whatever, there are still consumers that are typing their credit card number into this scam. And then they can't get out, right? And there's no ability to escape. There's no ability to unsubscribe. Like, someone needs to close this down because it is actually still hurting real people, even though we laugh about it now on a regular basis. So please, anyone, please make this go away. Yeah. Jason, can I give you what I think is actually a pretty like wholesome, non-crypto-y, non-scam can't let it go?
Yes, please.
Okay. So I assume, global traveler, frequent traveler that you are, you've flown Southwest Airlines before.
Okay, I've literally never flown Southwest because when I lived in Chicago, Southwest flies out of Midway, which is on the southwest side.
Oh, yeah.
And I was a North Sider, primarily living along the Blue Line. The Blue Line goes directly into O'Hare Airport.
So you're a United guy.
It was just the travel time of like taking the Blue Line into the Loop to switch to the Orange Line to go out to Midway. Even if it was cheaper, it just like it wasn't worth the time. And that's a shout out for my Chicago people listening.
I was going to say that was some good local Chicago travel background.
Never flown Southwest in my entire life.
So you never got the experience of getting onto a Southwest flight that would load just randomly, seemingly.
I'm familiar with the concept. Okay. But I've never had it, no.
I was familiar with the concept too. I had never flown Southwest. I was flying Southwest for the trip that I was doing this week. And the day I was flying down was the last day they were doing that form of loading onto a plane before they switched forever to the system that every other airline uses, which is actually assigning you a seat. So I would just like to say quickly that I can't let go the experience of both having to navigate this as a new person as a part of this, while also going to what sort of felt in some senses like a wedding reunion, where it was like everyone was saying goodbye, or a funeral almost, saying goodbye to this system that doesn't really make any sense and that is inefficient and just causes drama and problems, but everyone was kind of like weirdly nostalgic for. And so there were people on the plane who were like hugging each other or high-fiving as they were randomly sitting next to each other. The stewardesses were like making jokes on the plane about it. And meanwhile, I'm like going through it being like, is it okay that I sit there? Like, what is happening right now? And it was pretty amusing. I did fly back on Southwest once they had embraced the new system. Everyone seemed pretty frustrated with trying to get people to understand the new system, which is kind of how we've all been traveling for a very long time. And I did have an occasion where I sat in my seat. A woman came down. I was in a middle seat, and she was coming down. And she was like, "Oh, do you want to sit on the aisle?" And I was like, "Well, I'd love to sit on the aisle. Let's switch." I didn't know why she was switching exactly. I was like, "Okay, but sure." And then someone else came down and was like, "You're sitting in my seat." And it turned out that the woman who offered me the aisle seat did not have the aisle seat, but wanted my middle seat. And so we had to completely like reset and figure out where everyone was supposed to be. So quite the experience. I'm glad I got to do it one time before. This is now going to be like consigned to the history books as a thing we used to do that was stupid that we don't do anymore.
That is a lovely anecdote to end on.
I figured it would be, yes. So I will be thinking about this. Jason, about 6 months worth of news is going to happen between now and the next time we talk. I look forward to breaking this down again with you. And as always, thank you for your time.
Yeah, till next time.
Thank you for listening to this episode of Fintech Takes. Stay up to date with emerging companies and the latest fintech trends by subscribing wherever you get your podcasts. And if you love Fintech Takes, please tell a friend.